I hope this thing's broadcasting. It was the other day. I went through the same procedure, but the little green thing on the side's not lighting up like it should. Well, we got about 6 out of 22. That's not good. And we had assignments due today too, didn't we? And I guess they don't want those bonus problems, so unless they email them to me today, that's up to them. All right, we need to look at those problems real quick and move on into the chapter with cash flow that we started a little bit the other day. So let me find these solutions. We're going to look at them, review the cost method, the equity method, and that available for sale securities, trading securities. Don't let that terminology bother you. They're treated the same way.
The chapter 16 solutions, I was like looking at chapter 16, and when I do Cengage, I look at the book and the answers figured out. They're not the same answers. Like they don't go with the book for chapter 16.
Yeah, I noticed that.
So I don't know if
Okay, hold on a minute now. Cengage.
like I'm talking about the solutions that you pull up, but you have them on Moodle too. The chapter 16 ones aren't the right ones for the book.
Okay, now are you looking at my solutions that I put on Moodle?
Yeah.
Okay,
So I look at those.
well, right here I've got accounting 202 solutions. Is that what I have on Moodle?
No, you just have chapter 16, but it's the old book.
And then I went through like all solutions with chapter 16. It's different too.
Yeah.
They're not even the same ones.
They're the old book problems.
So
Could be. I'll have to probably try to get these installed then. I thought I did have them. I mean, I have to look at how the other chapters went. Okay, Margot, you didn't have class this morning? Carlos, come on in. You don't have to worry about the rest of them. They don't make it, you're still okay. I like the way these international students, they help take care of one another. Uh, I know Georgie did the Biden taxes last year, and I let him stay in the system with the IRS, and he come up and did about 7 or 8 tax returns yesterday for his international buddies. So they take care of one another. But now, solutions, Kelly, the solutions I put on Moodle, they weren't supposed to help us engage anyway, were they?
no, like they're for the book, but I look at them to figure out how to do Cengage if I'm confused.
Oh, I
They
see.
don't go with the book.
I mean, they're not the same numbers.
Yeah.
But
It's the same
they're similar
process.
problems though.
So you can look at your book and solutions to figure out Cengage.
Okay, I'll try to download the ones I have on my little jump drive on Moodle. We'll try to get that straight. If I ever forgot how to download, we'll work it out. And have you got an extra sheet of paper over there, Jessica? Did Miss Taylor have to be off today?
Yeah.
Yeah, I saw her. I was in a meeting with her yesterday. We interviewed somebody for that entrepreneurship job, and I liked him. I'm ready to hire him right away without seeing him or interviewing anybody else. He was that good.
Oh.
So he'd be a great addition to the college here. Were any of you all in FBLA in high school? FBLA?
For like 2 months.
The college version of that's PBL, and there used to be one here. About a year after I got here, I think they did some things. Of course, PBL, if you had dormitories, it would help. But at Williams College, I had PBL, and I took like 2 van loads, about 30 people to Chicago for competition. And we flew to California for competition. We even flew to Florida one year and drove to Florida. So come in, Arthur.
Good morning.
Morning.
Come in, Eva. Morning. Is Franco and Millie still out running around together? Is Franco and Millie still out running around?
Amelia's not coming.
Yeah.
She's injured, so she has to go to the training.
Franco meet the bus.
Millie always has to do something. Anyway, Jessica, just take a sheet of paper, sign your name, start it around. Okay. Well, y'all don't know a thing about Vince Lombardi time, do you? Vince Lombardi's time. You know who Vince Lombardi was, don't you?
Say what? What happened?
Have you heard of Vince Lombardi? No?
Green Bay.
Jacob, no. Football. He was a football legend. He won the first 2 or 3 Super Bowls with Green Bay Packers. Then he went around giving, motivation speeches and things like that. And he had one saying, Vince Lombardi time. Vince Lombardi time is be 10 minutes early when you're late. All right. If you go for a job interview, you better be 5 or 10 minutes early. Okay? So we're going to get a time clock for the classroom and have you clock in. If you clock in after 8:30, you're dog. 9:30, yeah. No, we won't go that far. Morgan, at McDonald's, do they clock in or
Yeah,
how do they clock in? Have you got a clock or a time card or
fingerprint.
they put that on a computer or so, what?
Yeah, like there's a clocking station and you just put your thumb on it for breaks, clock in, clock out.
Yeah, okay. Well, now what if they're 5 minutes late?
The manager has to authorize it.
Okay, and how many minutes do they have to be late before you dock them? A half an hour or an hour?
It's actual time, like it's exactly on the dot. Or whatever, like if it's from 9:57 to 10, you get paid for that 3 minutes.
You do get paid for the 3 minutes or not?
You do, what they do is they always go over instead of under. They don't ever short, they always
Yeah.
project it over.
Anyway. Try to be on time. That's the request. All right, let's look at problems in chapter 15. We're going to end it up today, forever leave it, and get into 16, more cash flow. I don't know when we'll have a test on these 2 chapters. Next Thursday, they will only give us Tuesday on that chapter on cash flow. But Mr. Hamel wants me to go somewhere out in town for some kind of business meeting. So I'll let you know Tuesday what we're going to do with this class and so forth. Whether I'll plan a test for you to be here and somebody else administer it or what. We'll see when the time comes. Let you know Tuesday. All right. You are leaving corporations after chapter 15. I really don't think cash flow is as hard. And somebody, who in here has taken finance this semester? Who's taking finance? Evan. Evan's already had cash flow and finance and ratio. So he's had 2 or 3 of the chapters in finance that's coming up in accounting. But if you have them in accounting, that will help you then in finance. So, and Kevin says it wasn't too bad, I guess. All right, we had problems 1, 2, and what, 4 or 3? Okay, looking at problem 1, We purchased 100,000 shares of, I guess, of Wells Company. No, $100,000 worth of bonds at their face amount plus accrued interest of 500. All right, making that entry real quick, Alexander. Let's start with you on that one.
Debit investments for 100,000, debit interest receivable for $500, and then credit cash for 100,500.
I don't know. I'm way off.
That was your chapter 16 solutions.
That was the wrong chapter. Okay. No, that was chapter 1. I don't know why I would click on chapter 1. Way off. Uh, well, that's not going to show up very good, is it? So repeat that again. Alexander, debit investments for how much?
100,000.
All right. And the debit,
Interest receivable for 500.
all right, debit and,
Credit cash for 100,500.
all right. Now we bought interest receivable. We paid for it. Now, when we hold that bond to another interest payment, we get that interest back. So be careful with that when the test is coming up. Your next test will probably be mostly problems, which I think a majority of you like problems. All right. Purchase $210,000 of 10-year bonds at their face value and plus accrued interest of 700. The bonds pay interest on May and October. Now that's the same entry. You'll debit the investment for 210, interest receivable for 700, and you'll credit cash for 210,700. All right. Receive semi-annual interest on the Welch bonds. That was the first bonds. Safe, do you happen to have that entry? All right. Margot, do you have that entry there?
Yes, second one. Debit investments, 200,000. Debit.
No, not that one there. Next one, next entry, the interest.
Okay, so debit cash for 3,000. Credit interest receivable for 500. Credit interest revenue for 1,500.
Yeah, that entry's here somewhere. You see, you debit cash for 3,000, right? And credit interest receivable for 500, and then credit. What'd you credit for 2,500?
Yeah.
What did you credit for 2,500?
Interest revenue.
Interest revenue. These are just bonds. It's interest revenue, interest receivable. All right. Sorry about these solutions. Now we sold 40,000 of the Welch bonds at 97, and we sold accrued interest at 200. Well, what is 40,000 times 97? What's 40,000 times 97 plus 200? What? All right, 40,000 times 97 is 30.
Oh, the times 97 is 38,800.
All right. And then we have to add the 200 to it. And I probably don't have that. This is what a mess. Mess. All right. Something shouldn't release these. Okay, what's your entries on that one, Kelly?
Debit cash for 39,000, debit loss of investment. Credit interest revenue.
You credit interest revenue because your bonds had already had some time on them. Now, you only got 97 when you paid phase 4. You paid 100. 100 is phase. 97 means you're going to have a loss, right? You're going to have a $3 or 3 cent point loss. Okay. All right, want to get rid of this one. Okay, Now, the rest of this problem was receiving interest, so we're going to bypass it. We're going to go to 2 and invest in stock. Problem 2. Hopefully I have better solutions. Probably don't. All right, now the first entry on number 2, we purchased 7,500 shares as a trade security, $50 per share and brokerage fee. Evan, do you have that entry?
Yeah,
Debbie?
debit investments, $75,005, credit cash for $370,000.
All right, whatever you pay for the stock plus the brokerage fee, debit investment, credit cash. It's messed up here, but at least you can see it. I don't know what's wrong with that TV there this morning. I'm gonna turn this around, just watch when you stand up. Okay. All right, the second entry, we purchased 5,000 shares of Holland as a trade security at 42 plus a brokerage fee. And we're going to have the same type entry. Debit investments Holland 126,090 and credit cash Holland 126,090. Well, credit cash. And then July the 1st, we sold 4,500 shares of this company for 46 a share, less a brokerage fee. Now, just multiply 4,500 times 46, subtract the brokerage fee, and how much cash did we get?
806,800.
And then loss was 18,155. Now, the investments, how'd you figure out the 225 investments, Jessica?
Added both of them together.
All right, how much did you pay? How much did you pay for them? Up here at the beginning,
You do
right here.
375,075 divided by 7,500, and you multiply whatever number you get times 4,500.
That was your basis, more or less like a base. That's what you paid for. And that's what you credit for 225,045. And you only got 206,890. Where you had a loss, okay? I don't know how much we paid the share for them, but we sold them for 46. You look back up that entry, what did we pay for them?
50.
We paid 50, didn't we? And we're selling for 46, so you got to find your loss. Okay, we received an annual dividend of 50 cents a share. Now, here it said nothing about the equity method, so it must be the cost method. So, Alexander, what's that entry?
They going on account.
The dividend.
You will debit cash for 1,500 and then credit dividend revenue for 1,500.
All right, cost method. We credit dividend revenue. What if this had been the equity method? Evan, what if this had been the equity method? Morgan, what if this had been the equity method? We'd credit what? Investment. If it was the equity method, we'd credit investment. All right. The portfolio of trade securities was adjusted to fair value of 47 a share and $40 per share for Caldwell and Holland. Well, 47, we know that's a down value. And how much did we pay for in Holland? We paid 42 a share, and it's worth how much a share? It's worth 40. It looks like we're losing money. So I'm not gonna pick on you for that one. I want you to look at this. Um, all right. Number of shares, 3 and 3. Cost per share, that 1 cent comes from your brokerage fee, 3 cents. Now the par value per share is 47.40. So cost was 276, 120. Par value, here's cost times 3. Par value times 3. Difference here and here should be 15,120. Unrealized loss and credit valuation. If it were a gain, you'd credit unrealized gain. Okay? Now let's make an adjustment at the end of a period on your balance sheet. You don't have a real gain or a real loss until you sell these things. All right, we purchased 5,000 more shares. We know that entry. Received an annual dividend of 52 cents a share on the Caldwell stock. We should know that entry. So look at these next two entries. For debit investment, and then of course July the 31st, we got a dividend. 52 cents a share times 3,000 shares. Then we sold 1,000 shares of Fuller for $28 a share, less a brokerage fee. We will have a loss there. And then we make an adjustment. So look at these last two entries. I'm just trying to speed things up a little bit. Be careful with this one. Again, 1,000 shares times 28 minus 100 is what you received. That should be the 27,890 cash. Now, what are you giving up? You had 125,100 divided by 5,000 shares, multiplied by 1,000, which will give you 25,020. So your investment was 25, cash is 27. You had a gain. Now, another one of those valuation allowances. And here we had valuation allowance for 58. We had a gain this time, I guess, of, or did it? All right, we had a gain, I guess, valuation allowance and then credit gain on investment. How does that show up on the balance sheet? We show investments at cost. We have a plus or a minus. In this case, a plus, almost like accounts receivable. Accounts receivable minus amount for bad debts, or like equipment minus accumulated depreciation. Here you got trade investments. It could be a plus or a minus. Plus if it's a gain and minus if it's a loss. All right, that's problem 2. Now both of those, one was bonds, one was stock, cost method. What was your next problem 3? All right, now here we should have the equity method. We purchased 22,000 shares of stock as available for sale security at $18 per share, including the brokerage commission. Now, if you read the upper paragraph, the company started operations. The following transactions relate to securities acquired, which has a fiscal year ended. Now, here we're using the equity method because it told us to. Other than that, you'd have to divide how much stock you bought by how much stock they sold. That gives you your percent of ownership. It has to be over 20 to be the equity method. So, Jessica, how about this first entry?
Investments to Sandfall Incorporated for $396,000 debit and credit cash for $396,000.
There
it is right there.
I ducked too far. Didn't have a All right, debit investment, credit cash. 22,000 shares times $18. All right. Now we're going to receive a cash dividend of 22 cents a share on this stock. Okay, a cash dividend of 22 cents a share, that's easy to multiply out. But so far, we're still calling it the cost method, dividend revenue. I mean, it's the cost method. I told you probably to use the cost method unless they give you the shares of stock. So in this case, the cost method. But we'll get to the equity method. All right, a cash dividend of 25 cents was received on the stock. March the 8th and September is just two cash dividend payments in. March, 6 months later, September. We sold 3,000 shares of this stock at $16 a share, less a brokerage fee. All right, we paid 22,000. I don't guess that includes the brokerage fee. We paid $18 a share. We're going to sell them for how much? We're going to have a loss, aren't we? Now, let me show you that entry. You'll definitely have a loss. You paid $18 a share for them. That's what you credited at 54. Cash you got, 3,000 times $16 minus your brokerage fee. The difference is your loss of $6,075. Trying to get down to some equity. All right, here you'd have to make an adjustment on the 31st, just like we did. Whether it's trading securities or whether it's available for sale, makes no difference. Valuation allowance, 133,000. Unrealized gain, 133,000. You gained $7 a share times $19,000 if you sold it today. All right, now we're going to purchase an influential interest for $720,000 by purchasing 96,000 shares directly from the estate of the founder of this company. There's 300,000 shares available or outstanding. We got 96,000 out of 300. What percent is that? Somebody divide 96 by 3. Since that's somewhere around 32%. Right? Because I know 100,000 divided by 3 would be 33 1/3, and that'd be a little bit less. I figured it's 32. Okay. All right, so we're paying $32 a share. Now we received a cash dividend of 30 cents a share. Okay, Eva, do you have this next entry? All right, debit investment and credit. All right, Eva, first off, dear, are you on problem 3, year 2, March 10? Is that where you are? Year 2, March 10. All right, what would you debit? All right, what would you credit? All right. I hope you all understood her. I didn't, but it sounded totally wrong. Was it wrong, Eva?
She gave you the March 10th entry.
Did what?
You said March 10th.
Oh, okay, I gave the wrong one. Okay. All right. Here was investment credit cash. So let me get down to March 10th. That's what she said, 57. All right. But year 2, that was a dividend back on this stock up here, wasn't it? Yeah, that was the cost method. Now, on September the 12th, we're going to receive a dividend plus an extra dividend of 5 cents a share on the shekel stock. Now, notice the difference in these two entries. Carlos, do you have this next entry, March the 12th or September the 12th? He's taking a break. Arthur, do you have this next entry? Franco?
Oh, yeah.
All right. Evan,
Yeah, I have
what do you got? Yeah.
debit cash, 700, credit debit, 700.
That's March 10th. Have you got September the
It's the same.
same thing, isn't it? That's the same old entry, same old company.
It's just really different.
Yeah. Received 57,600 cash dividends on this new company. Okay, Evan, help me out again. On December the 31st.
Debit cash, 57,000, credit 57,000.
All right, you see those two entries. That's the two I wanted to compare. Cost method, equity method. I don't know how much we own here, but we own 32% here, didn't we? That's 20 or above. That makes it the equity method. So that's what to be on guard for on the test. All right, the last December 31st, I'm just going to flip that up there. Whatever percent we own and whatever income they had, we multiplied 450,000 times 32%. Now that's ours because we own that much of the company. So we debit investment and we credit income, okay? And we also have unrealized gain when we make these adjustments. Unrealized gain, loss, really 57, credit valuation, really an unrealized loss. And here's the way the balance sheet would look. Current assets for investments as available for sale at cost, investments on stock, and stockholders' equity. All right, if you have these three polls, I will take them up. Fold them long ways, Alexander. Just fold them. Everybody fold them long ways. I don't want to pass the paper around. All right. I'm assuming that some of you are going to do well and you're going to need bonuses. We'll see. All right, now I want to bring you PowerPoint. We're going to leave that chapter. Possible we would have time to review it, but I don't know that. Does anybody remember from Tuesday what little we went on cash flow? Where are the three sources we get cash from as a business? Operating, investments, and finance. All right. It's just cash in and cash out. It's used by managers to evaluate past operations and plan the future. And they mentioned operating. This is transactions that affect net income, like depreciation and accounts receivable and so on. Cash flows from investing. These are non-current assets. And cash flow from financing, which is usually equity, could be bonds. We take operating, investing, and financing, and these three answers are given to you on your balance sheet. And cash inflow from sale of products, we will get that when we get net income. Now, we use money to purchase inventory, to pay employees, to pay taxes, and tie up even in accounts receivable. We're going to be dealing more with the indirect method. We'll quickly look at the direct. Now, these two methods are the same for investment and financing. Only the operating is different. We won't look at this direct method yet. We take cash flows from net income and we make these adjustments. And that's increases and decreases in current assets and depreciation. Again, I'm not interested yet in the direct method. We'll study one at a time. Changes in the company's long-term liabilities. Could be stockholders' equity. Cash flow from financing activity reported on the statement of cash flow. All right. Best way to practice one of those. All right. Here is a statement of cash flow. Net income plus depreciation. And here they're just giving you headings. I'll tell you the number that 1, 2, and 3. Increase in cash plus beginning minus ending. All right. All right. How about A there? Anybody? Purchase of pet. Where would that go? Where? You say investment. All right. So we'd do investing. How about payment of a cash dividend?
Finance.
Now that's a cash dividend.
Finance.
You are paying a cash dividend. I'm trying to think. You sell stock. Stock is financing. That's what you said, wasn't it? Okay. Disposal of equipment. be investing, cash sales.
Operating.
Now that more or less we worry about that on the direct method, but it's still operating. Purchase of treasury stock
Finance.
and payment of wages.
Up.
All right. Cash flow per share is computed as follows. I usually don't worry about this ratio. Cash flow from operating divided by the number of shares. I usually don't worry about it. When we come across it, we will work it. Preparing the statement of cash flows. We're going to look at changes in the liability. Now, I'm looking at the operating part. Changes in assets and liabilities. All right, now, if you were doing a cash flow statement, what numbers do you need from this income statement? What numbers do I need from this income statement? I would need net income. We'll jot that down somewhere, 108,000 net income. What else do I need? This is all new, but what else do I need?
Gain on the sale of land.
What?
Gain on the sale of land.
Well, that may be given again, but I would jot it down. And the other one is I'd jot down my depreciation expense of 7,000. As far as I know, that's all I need from that income statement. Okay? Now look at that balance sheet. Look at the balance sheet. Now, first off, we need, let me try to blow it up a little bit. Now, first off, your answer is going to be these three numbers, right? That's going to be your answer on your cash flow statement. Keep that in mind. Now, I need the increases and decreases. Now, this is Y7, and this is 2018. Okay? Now, did accounts receivable go up or down? All right. If they went up, we tied up money in accounts receivable. And I'm going to put a minus, even though it says a plus here, it's going to be a minus on your statement of cash flow. Now, what did inventories do? Go up or down? That's going to be a plus on your cash flow. Now, now that is for operating. But when we get down to land, did we buy some land or sell some land? Looks like we sold it, don't it? All right, and the building, what do we do there? We buy more building or sell building? We know that's going to be a minus, and we know that's going to probably be a plus. All right.
Why is it the office?
The what?
Why is it the office?
I'll show you on the statement. Okay. All right. But now somebody subtract. Now, if you subtract year one, accumulated depreciation, from year two, is this the same number I told you to jot down from the income statement? It's the depreciation expense. If they don't give it to you, then you got to find it here. Now, liabilities, did they go up or down? All right, they went down. Now, you paid some on your liabilities, and that will be a minus. All right. Accrued expenses, did they go up or down? Now, that's going to be a plus because we're borrowing somebody else's money. Income tax payable, up or down? Now that's gonna be a minus because we're paying out some extra money. Dividends payable, up or down? All right, dividends payable went up. We're still borrowing money then, that's gonna be a plus. No, dividends not a plus because it's already in retained earnings. We paid out retained earnings. We'll look at that in a minute. What happened to bonds payable? Down, so we paid some off. I'm still gonna call that a plus for the time being. Now look at stockholders' equity. Up or down? We sold some, didn't we? So that's a plus. Paid in capital, that go up, plus. Retained earnings. Now, what's the difference in retained earnings? How much? Now, what was our net income? How much?
108.
All right. Net income, 108. We'll back up here. Right here, 108. Now, we're going to put all that in retained earnings. But we only left 80 in retained earnings. So 80 from 108 is how much? 28? We must have paid that out in dividends, okay? So we'll see how that works out. But we paid out 28 in dividends. Okay, now let's see. I don't know what they're going, where they're going with me here on this PowerPoint. Let me try to get it back to normal. Income statement, balance sheet, normal. Okay. Now the net income is 108. And if you look at the retained earnings, all right, the balance was 202. Dividends declared 14. And then your income was 108. Dividends declared 14. So 14 is 28. 28 from 108 is 80. So your beginning retained earnings subtracted from your ending retained earnings is 80. Net income goes into retained earnings, dividends come out. All right, and they show you the 28 there again. Now let's look at the cash flow. X's don't mean a whole lot to us. We figured out the depreciation. We figured out the 7. And there's the gain on the sale of the land. We figured out the minuses and pluses. All right, this does not look like, this is not our information, is it? We had 108,000 net income, right? And what? Jessica, are you having a conversation?
No, I started reading my book.
Oh. All right. Let's get down to what I want you to see on this one. Please go through all these transactions that they're showing you. All right, can't load that one up for some reason. Okay, here's the 108,000 net flow from operation, cash flow. First adjustment is add depreciation. Now, why do we add depreciation back to net income? Why would we say our cash flow is 108,000 plus 7, which makes 115? Because we did not pay cash out for depreciation, did we? That's why we add it back. Now, gain on the sale of land. I told you the other day, we subtract a gain because it's been added in 2 times already. It's added in once here, cash from sale of the land, that 12,000's there. And it's up here in the 108. We take it out. All right. Increase in accounts receivable, we're tying money up, decrease in inventory, decrease in payable, increase in accrued, decrease in taxes. Hopefully we got those pluses and minuses right when we were looking at it. Now gain from the sale of land. Well, cash from the sale of land. Cash used to purchase land. Cash used for purchase and building. That's a -3. Cash from the sale of stock. Cash used to retire bonds, and cash dividends of 24. All right, but how did we get that cash used? Let's see. Cash from the sale of common stock. Need to go back and probably look at that one to show you where that comes from. It's way back here somewhere. All right, this was just your operating part. I think those are way back. Let's see. All right, right here we go. All right. Okay, common stock went up how much? 8,000. How much did your paid-in capital go up? What's 40 plus 8? 48. That's how you get your cash from sale of common stock. Okay. All right, now you're going to look at that, and you're going to do one real quick, a short one, especially the operating, which we started one the other day. All right, now, did we do exercise 5 on page 801 the other day? Did we do exercise 5 on page 801? No? All right, let's do it today. Take a few minutes, put this down on plain paper. I want 100% participation. If you don't have paper, borrow paper. Who's got the book back here? You got the book? So, Rich, you had an e-book also. Here's a chair. You look at it, saves there. You got the e-book? Yeah. This thing's got me. If you don't have a book, you might be able to see it here. Here's the problem. Here's your income. Here's your depreciation. Here's your, you're not doing the whole statement, so you don't need to subtract here. Take the difference in your accounts receivable inventory and do the operating section of a cash flow. You can look at the example in the book or what have you. So, say, did you get started on it? I'd like for everybody to have this done before we leave this period.
I'm just wondering, I could have a game on Saturday.
We don't have it on.
Yeah, that's all.
Okay, we should be getting close, folks.
Well, I don't know if mine's right.
Not
I need to.
You want to take this? You want to take this? I got this, but it's not really. Yeah.
Everybody class was working with. One person asked. All right, let's start off with 73,600, right? Now we're going to add the first thing to that is a plus, is what? Depreciation. Now let's go down to accounts receivable. Did it go up or down? All right, went up by how much?
8.
Now what do you do with that 8? Add it or subtract it? Minus. Merchandise inventory went down 4,500. Is that a plus or a minus? Is that 4,500?
Yeah.
Now you sold merchandise inventory. You got cash from selling it. So that's a plus, isn't it? 4,500 plus. Now, look at this one. Prepaid expenses went down. Is that a plus or minus? Plus or minus? The what? All right, prepaid expenses has already been prepaid. Cash went out maybe last year. And if you're using this year's expense, no cash is going out forward. So, what is the difference between, let's see, what's the difference between merchandise inventory and prepaid expenses? What's the difference?
Expenses, that's minus.
But do they both go down?
Yeah.
If one's a plus, the other one has to be a plus? Yes. Kelly? I want you to straighten that out. Yours may be right.
It was
What was hers?
we take from
What was hers? And that hundred.
93,850, is that what you had?
eight,
Did you have 103,850?
Yeah.
Yeah, you matched with her. And she's pretty smart once in a while.
What about next?
We're doing awards this year, they're gonna be on April or something, and, we gotta recommend 2 people. Usually we do it for accounting, we did it for management part, we just do two per sophomore year. And 2 per junior year, and 2 per senior year, and then 1 overall. Of course, for your international folks, you know, I don't know what we'll get, I recommend Georgia for an overall award.
yeah.
So they can say when they get graduated, I hope another professor will be with me. And then when I started, looking at URLs, Kelly is a freshman. She don't qualify for an award. Margot is a junior. Sure.
Yeah.
Somebody here is a junior.
Or Alex.
Somebody's a junior. Okay.
There's
Then I had to pick out a couple of you all for the softball award. And that junior, whoever it was, I only had 1 in here.
I'm junior.
Were you a junior?
Yeah.
Okay, maybe it was you. Okay.
Yeah, I wanted less.
I know you did, that's a softball. We didn't even know.
Yeah.
We know you this year.
Because I was a transfer student when we.
Yeah, but you was that junior, okay? So, but there's good students in here, was, I recommended somebody, that don't mean you'll get it, because other professors have to vote on it. Okay?
Did you?
And Kelly, couldn't he be recommended, she was a freshman. Yes. 16 years old. You'll appreciate that when you get 80. All right, anyhow, that would be a plus. Accounts payable. What makes that a plus?
Because it's an increase.
You're borrowing money from somebody. And wages payable. You paid those down, so that's a minus, isn't it? All right? So Jacob, can I borrow yours for a moment?
I think I did it wrong.
What?
Because, yeah, that 900 needs to be a minus. Or wait, no, sorry, I just wrote it in there wrong.
You probably did.
Yeah, no, the number's right, I just wrote it in
All right,
there.
here's net income, depreciation, minus the 8, plus the 45, plus the 2250, plus the, what number is that supposed to be?
900, I put it in there wrong.
All right? Is it plus or minus?
It's minus. I gotta put it in there wrong.
But anyway, 103,850 is your answer. And Kelly, you got that matching now? You match it? And anybody else match that? All right now? You had it there. Oh, you just wanted princess around that, Jacob. Okay.
Yeah, I just forgot to put the price in.
All right. That is the operating part. Once we do a few of them, you'll get used to it. 3 or 4 of you caught on to it real quick this morning. Others, you'll have to work on it, but we will get it. So, for Tuesday, would you please read this chapter well? And also, I'd like for you to start on some exercises. And I don't want to do anything with a direct method yet. In fact, I don't like too many of the exercises. All right, I want you to do 16, 1A and 2A. The problem, 16, 1A and 2A, the problem. And see what you can do with those statements of cash flow. You know it's going to be on your next page, so please practice.
You have to do the balance sheet and everything on this next one.
No, that would be given. The balance sheet would be given, the income statement would be given, and you just have to do a statement of cash flow. That's what the chapter's about. And on a test, I'll give you the indirect method. This is what we'll study tomorrow. And you'll have a good weekend. I'll see you Tuesday.
Well, she. Yes, I mean, she's playing. No, her right. Yeah, we can put one more month.
Alexander, tell your 3 buddies. That's McKinley and that's Carson. Who's the other one?
Kendrick was here today.
Huh?
Kendrick was here today.
Oh, yeah, kidding. The 2 of you are here. Tell your other 2 buddies to make it to class. Okay, take care of you.
Yes.
Yeah.